Joining us right now to talk markets is Barbara Reinhard. She is Chief Investment Officer of Multi-Asset Strategies and Solutions at Voya Investment Management.
Voya.
And Barbara, are we new week and the correction's over?
Look, I think that it did feel like things were getting a little bit frothy. Our lead indicator of where we are in the market cycle rolled over from optimistic into neutral. It may indeed kind of come back with this, but I don't see big signs of speculation, big signs of investor excessiveness. So to us, I think that we can probably still continue to grind higher into the end of the year with continued strong earnings growth. Government reopening will give us some sense on the data. It looks like some of the labor market weakness that we were worried about seems to have been cut off with the better claims data, with better ADP data. So I think we're probably out of the woods on this one.
You know, for us to look at every wobble, last week was a disappointing week. The NASDAQ was down by 3%, but the NASDAQ is only down by just over 4% from its all-time highs.
Yeah.
The other major averages are less than 4%, maybe less than 3% from their all-time highs. So you can say the market's nervous, but I mean, it's hard to describe a less than 5% pullback as anything to write home about.
I agreed. And look, we haven't had a 2.5% pullback since April, right? And that was kind of the big 20% peak to trough decline. You'll see these little bubblets break, things in gold, things in Bitcoin, but it's unlikely to take the rest of the market with it when you have EPS growth and earnings growth being so strong.
So what does take the market down by 10%, 15% or more?
Fed tightening. Every single major market top and bear market correction of 20% or more are generally led with Fed tightening, an aggressive Fed tightening, or an exogenous shock to the economy like we had in April of this year.
Yeah, the exogenous shock, it was shock about tariffs.
Yeah, it was. But it was an exogenous shock because it kind of came out of the blue.
Okay. So what do you tell people to do at this point? The earnings were pretty good earnings so far that we've seen.
Excuse me. Earnings are great. And if you take a look, yes, the S&P 500 is expensive at 23 times earnings. But if you take a look at the equal weighted index, you're only at 17 times earnings. That keeps the market in check. And the Fed is easing at this point. This is generally periods where you continue to see very high single-digit to double-digit equity market returns over a 12-month horizon. There will be wobbles from time to time on general concerns in the markets, but the underlying strength that we see is relatively strong at this point. And if you're really nervous, there's other places to go to besides the S&P 500. The emerging markets look relatively good. Healthcare has lagged this entire year. It looks like it's finding its footing, of course, today. So there's plenty to do in the markets than just necessarily be worried about the next 5% correction.
How do you judge if there's more speculative activity in the markets?
You look at a lot of things. You look at put call volume. You also take a look at investor sentiment surveys. We have about 10 to 15 of them that we look at on a daily basis. We don't necessarily see a lot of speculation at this point. Yes, is retail continuing to buy? Are flows continuing to come into the U.S.? Last time we looked at the tick data, yes, the U.S. is still continuing to be bought by foreign investors. So that tells us that you don't necessarily have a lot of speculation. The real speculation that you had in the late 1990s into the early 2000s with the tech bubble was that you had companies that were going up on concepts and didn't have earnings behind it. You don't have that this time. So if I had to put us in a place of where we are in the 1990 cycle, you had 10 years of capital spending boom. You've only had 3 years of it at this point on the hyperscalers. We think that there's certainly more to go. If I had to put us in a context, you're probably somewhere around 1997, 1998.